Hello, it is Monday, December 21st. This is the weekly stock show, Stocks of the Week. And we're going to go through some Q&A. That's kind of going to be the theme of the week. Sunday night, we are going to have a year-end Q&A session. Since we're not doing a show on Friday, a couple of updates. Sunday night, 7 p.m. Central Time, we will do a Q&A. Get your questions in through the chat. I'm not going to be taking really any on air because I'm sure there'll be just too many to cover. So get everything in on the chat. Give me a little chance to prepare ahead of time. I will send out all the details. So tonight we're just going to go through a handful of stocks for the next half an hour or so. All right, somebody asked about Great Lakes Dredge and Dock. First off, this is a company that I pointed out, I don't even know when, back in here somewhere. And it's been running up on the idea that there's going to be a lot of work along the coastlines to prepare for climate change and to mitigate climate change. So that is part of our barbell strategy, to look for companies that benefit from the whole move towards sustainability and mitigation of climate change. They have rallied quite a bit since March. I think they're much higher than I'd want to pay for the stock right now. I think that a pretty easy place to buy them would be down around $8 or $9 a share. You know, you have a fib level, a couple confluence here. So that looks like pretty strong support. You see that's where it got down to on the correction. And this is going to be a recurring theme today because I see some of the questions. Folks want to know if we should be moving some of these buy zones higher. In some cases, yes. In some cases, no. But especially with ETFs, take a look at the underlying positions. The underlying positions will tell you the story of whether or not a particular ETF has gone up too much. So we'll get to that in a second. But as far as Great Lakes goes, yeah, there's lots of good news with these guys, and there's going to continue to be good news. But remember, it's not a subscription-based service. It's not something that's going to just print money by having new subscribers and new customers. Everything they do is capital dependent, meaning that they have to put in a lot of money to expand their business. You just have to consider that the only time you want to buy a company that is dependent on putting capital in, you need a really low price. You can't rely on multiple expansion, but when you get it, that's something to sell into usually. As far as this goes, if they put $1 in, you have to take a look at their margin and see what they're going to get out. It's not like Google or Facebook where they put $1 in and they might get $1 zillion out, right? This is a capital intensive industry. Capital intensive industries grow less and expand less, and they revert to mean. So the reversion to mean that you get in capital intensive industries is very real, whereas there's not a lot of reversion to mean for companies that don't have to put in a lot of capital to get more customers and more revenue. That's why this is not on the plug and play anymore. It was on the plug and play back in here. It's not on the plug and play up in here. I would have to get a very good correction into this area here for me to want to buy it. Somebody asked about ARK, and this gives me a chance to talk about Tesla. This is an ETF, and people want to know, is the buy zone still at 62? And I'd say, yeah, probably, right? I've got it as high as 76 here. However, I think this lower 60s area is something to keep an eye on. That is not a normal chart. Look at this. Look at how high it went up on all of that liquidity. Does anybody truly believe that the markets are going to remain so liquid? If you do, you're delusional, just like all the millennials who have no sense of perspective on history. You can't pump this much money into the markets without having a reversion to mean there. Why? It's a pretty easy answer. It's because you'll destroy the currency. At some point, there has to be a reversion to mean on the liquidity, and we know that the mean is higher now. You throw out the much older historical context, but you should probably be looking at everything back to about 1980. And keep in mind, the interest rates have been coming down for 40 years and are now near zero. It's very difficult to expand liquidity anymore. And the only way to protect the currency is to dry up liquidity, even if interest rates stay low. So when you take a look at this and you say, oh, I'm missing out. Well, there's not a lot of buying pressure in here, is there? Here's some chasers. If this comes down, your latest chasers will trade out. It'll go right through this area and get into this area for sure, which is around 90. Now, if you think the world is beautiful at that point, you can start buying around 90. And we'll just have to play it by ear. But the next level down, quite a bit further down before you get heavy buying pressure again. And really come all the way back down to the March levels. I don't think that happens. That's why, I start looking at it right in here, because this level probably moves up, even if we blow through this level, which I think is a coin flip. Tesla, biggest holding there. Here's one of the dumbest charts in the history of the world. Does any of that make sense? That it goes like this, still not making money, right? Excluding tax credits, they're not making money. And it goes up a zillion %, right? I think a number of us got a double out of this. I don't know if anybody held it for the 10 bagger, but now that they're in the S&P 500, and did they end up going up today or down today? They ended up going up. Is that what's going on? No, that's a monthly chart. Let's look at the daily chart. Yeah, they were down today, right? Yeah, they were down 6%. So you take a look at this and go, okay, what's going on with these guys? I don't even know what that is. Take a look at this and you say, okay, where's the buying pressure? It's way down here in the 400s. Right now, they're still in the 600s. Super duper easy to see Tesla come down into the 400s. Super duper easy. And if it does, that's going to drag down basically everything that's in that group of high flyers, but in particular ARK. So I would be very cautious. Let's just take this back to March. Let's go year to date. How's that? Easy. Easy button. That's your next big support level here in the 400s. It would not be unusual to see it come back into this area. I don't want Tesla anymore. It would have to really, really come down, I think, further than the 400s for me to want it. And I probably want it in closer to 270 here, 280, 290, 300, right in there. But you could think about buying it in the 400s. And this is where ARK becomes attractive again, too. So if its biggest holding comes down 30%, which doesn't look hard, that means that ARK can come down 30%. Pretty easy. Now, one of the holdings that we'll take a look at is Komatsu. KO, is it? So Komatsu is the former Joy Global, which is the former Harnischwager. How would I know something dumb like that? It's because it's a Milwaukee mining company that was bought by the Japanese a couple of years ago. I knew one of the lead lawyers on packaging the company to be bought. As the world electrifies, what do we know? Going to need a lot more minerals. So this company got beat up because of the end of coal. And now it's going to rise up because of needing more zinc and more copper and more silver and more lithium, right? These guys are competitors to Caterpillar. So between them and Caterpillar, pretty interesting companies. And if you want international diversification, Komatsu would be your Japanese partner to Caterpillar. And I think that this company probably runs back up to the top of this range, right? So it can go from in the 20s now all the way up to 40-ish. Now, does it break out from there? Or does this end up being resistance again that it comes off of? Hard to know. My guess is that they're in the midst of a decade-long bull market, and there'll be slide backs, but I think it'll be buy the dips on this one for quite a long time. So if it comes down to, and we haven't charted this, so we'll chart it. If it comes down to 618 level, 24-ish, I think you buy this at 24-ish. Let's take a look at the extension, see if it says about the same thing. Again, I use weekly charts. Once you decide that you want to buy something, switch on over to the daily chart to figure out exactly how you're going to get in. 0.5 line, got a little bit of overlap there. Yeah, 24-ish. I mean, I don't think you're hurting yourself if you buy it now. However, remember, another capital-intensive company. You got to get it on a pullback. These stocks, even if they rally and they have that straight up line, you better have some very good quantitative reasoning for why that stock's going to blast through. Man, that looks like about right. Pretty narrow range there, actually. On bad news, I guess you go down to here, right? Again, remember, this capital-intensive company just about to break out of there. So I think you buy it back here. That red line is basically where the big buying pressure is. So that's about 22. So 22, 23, 24. That's really where you want to get in on this one. So somebody asks ETFs for alternative energy. It hasn't been easy to get in since September. Do you chase something? Do you find something different? Or do you just be patient? I think you're just patient. I think you saw today that the stock market is starting to realize, hey, the big liquidity run-up is probably over. We know that the Federal Reserve is losing money, right? Because they got it taken away by Mnuchin. We know that Janet Yellen and Joe Biden would prefer to do things from the fiscal side, which are good for the economy, but don't really help liquidity in the short term. So if there's less Fed liquidity and the fiscal stimulus takes time to get in, right? Because ultimately we need employment to really drive retirement plan contributions again, which are a big underlying factor in the economy. If liquidity dries up a little bit and you get that month with margin calls, you're going to have another month like March. Now, will the S&P 500 get all the way down to 2,000-ish? I doubt it. But 3,000-ish, I think, is almost a layup. And could it get down to 2,700, 2,400 like some others? Yeah. I mean, the temptation is to drag your targets up because, well, it's higher now. But that's just not how it works. Anytime you take a look at any graph, a chart, and you put it out over a long enough period of time, it looks smooth on the way up. Let's shrink up the S&P 500 or QQQ. These drop-offs are getting faster, and this one was real sharp. And then this is all driven by the whole notion that the world's changing, and that notion is right. That's what the Macro Monday article that I actually just finished discusses. So you take a look at QQQ and you say, okay, look at that. Look at that. These are very fast moves, right? But look how deep. And we thought that 2018 was fast and deep, 20% in 3 months. Well, right? Bigger and faster. I think bigger and faster when you have a market that is driven by retail investors for the last 6 months, 7 months now, that are high on liquidity. Eventually, you're going to get another month like this because leverage on leverage insists on corrections. It's just a matter of when. And they usually go to the same support zones. 240-ish on QQQ looks pretty real to me, even though we're over 300 right now. And this is the favored index. If Tesla, which is big now, drops 30%, you end up with some pretty big problems. Again, chopping along here for quite a while, aren't we? Now, can it follow this forever? I mean, forever is a mighty long time, according to Prince. But, I guess, theoretically, chop along up here, never have another big correction. Again, I just think it belies history to think that those things are realistic in nature. So I would expect an S&P 500 to approach 300, or the SPY to approach 300, S&P 500 to approach 3,000. Then you're going to have to measure it at that point. Is there another level down? Is there another level down? We don't know yet. We don't know what policy is going to be. We don't know what the disease is going to be. We found out this weekend that there's a mutation in Europe that apparently started in the UK. I think it's funny that I coughed right when I started talking about coronavirus. The mutation of coronavirus makes it even more easy to get, right? More contagious. What if the next mutation makes it more deadly? What if that mutation makes the vaccines less effective? This is a long game, folks. All the people who have been trying to get you to believe that this is a short game, they're just wrong. Scientifically, they can't really be right. This is a long game. We know that liquidity can't stay super liquid forever. At some point, there really has to be at least a semblance of normalization. And as I've talked about, eventually, there's going to be helicopter money to fix a lot of things that have slowly gotten worse over time. I've always thought that would be around 2030. That recent study that I mentioned a few weeks ago says 2026 for the culmination of all the debt issues. We'll see. Yeah, I don't think you want to trade options on Komatsu. I think you just want to find a good entry point. Komatsu is a lot like Freeport-McMoRan, a lot of these cyclical stocks is just get in cheap and then play out the cycle. Don't try to be perfect with options. Range-bound stocks, right, to have a more narrow range, options make more sense. But when they go mostly down and then mostly up for long periods of time, you just wait for the mostly down to be over and then ride the mostly up. A stock like ET&T, even though the premiums aren't huge, that's been range bound for 20 years in a pretty narrow range. That's a great one to use options on. But the more volatile cyclical stocks, stock like Komatsu or Freeport-McMoRan, where they really rally hard for a few years and then they drift off for years after that, there's not a lot of options to do there. You want to ride the rally up and have nothing to do with it on the way down. Somebody's asking about microcaps. Yeah, I'm looking at microcaps, and there was one stock in the VSL that I mentioned was one of the utility stocks. Let me pull up as I put some strike throughs on here. These are super high debt companies. Some of these I just don't want, and they underperformed. So relative performance over time is important. Southern Company, they stopped being a good stock a long, long time ago. Dominion Energy, I don't like that they had to sell assets that I liked, and they've trailed. Avangrid, we've taken a look at these before. If you put in Dominion, all right, look at how long it's been since this stock really did much. It's chopped for years and then had that fall off, but you can go back even further, right? It's been 6 years that's been range bound. What's exciting about this stock, right? I don't even see a buy zone for these guys. And realistically, what's to say they can't get back down to here, all the way back down to 50? Right? Why couldn't it get down there in a regulated world where they have to replace all kinds of their production, right? All kinds of their generation, they have to change. Again, capital intensive in a world that can't possibly sustain all this liquidity without creating major inflation. I think, let's look at that. I think Dominion's a zombie stock now. What do we want to compare it to? Compare it to Avangrid. Compare them to AGR. Compare them to Wisconsin Energy. Compare them to Cell, right? Just looking at this, let's pick a 5-year chart. Which ones do you want to be invested in? You want Avangrid or Dominion? You want We Energies or Excel? Hey, let's throw in relative performance matters. You can move this, see almost any time frame going back for years who the winners are. Relative performance matters. You want a better performance, right? These don't look like week-to-week trends. These look like long-term secular trends. There's something in their favor. These are the alternative energy companies. These are the ahead in the game on alternative energy and have some transmission. Both of those assets have transmission, right? Which has been a theme that we've talked about a long time. These companies, old utilities, don't want them. So go here, Algonquin and Azure. And somebody wanted to know which company I was talking about last week. This is one of them. That's what these guys are. Wind, solar, hydroelectric, thermal. Very good company, I think, over a long run. I'm not interested in Kirkland Lake Gold. If you want gold, stick with Barrick, stick with Newmont. In any case, take a look at those newer utility companies because the older utility companies are just not exciting at all. Not look at stocks as gambling vehicles and to learn about the companies that you're investing in. The charts are for something after you've determined you want it in your basket. Why did stock price go up? I don't know. Pick a narrative. I don't care which one. They're probably all wrong. The narratives mean so little. Like on Seeking Alpha, we got this ridiculous echo chamber. Like the two echo chambers that I think are the worst on Seeking Alpha is the one that dividend stocks beat growth stocks. That's just not true. It's just not true. Because companies that pay dividends are usually through their high growth period. I mean, there's an exception. There's a group that's an exception. And then the other one is that the REITs, so that real estate outperforms the stock market. That's not true. We know that real estate beats inflation by a point or two. It's just on the leading edge of inflation. Now, I think that may change a little bit, but in a world where we've had interest rates falling for 40 years and are now near zero, something that you absolutely, and this is the most important thing I think out there, you must wrap your head around the fact that you don't have improving interest rates at your back anymore. As interest rates fell, that allowed companies and governments to run up their debt in a chase for growth. What happens to all these stocks when they can't finance cheaper than they did yesterday? They're all at that point now. It was so bad in March that you had to have the Federal Reserve basically bail out the corporate bond market. So all these companies, I think was a $1.2, $1.3 trillion of new debt, corporate debt. They couldn't pay off their old debt, right? 20% of the companies had revenues so low that they couldn't cover their interest expense. That's up to 30%. If you bought Barron's, you'll know this. 30% of the companies out there can't cover their interest expense with revenues right now. And some of those companies will be able to once the economy recovers. But even before coronavirus, 20% of the companies couldn't cover their interest debt, their interest payments. They had to borrow more money, like Chesapeake Energy, which finally went bankrupt, did to pay old debts. We're near the end of a debt cycle that's lasted 40 years. Now, can it move sideways for a very long time? I think so. But that just means that these companies have got to start paying down their bills. So when you study these companies, if you're looking at a capital-intensive company like Great Lakes Dock, you have to ask yourself the question, to what extent do capital requirements limit this company's ability to increase earnings? Because in the long run, the earnings matter. In the last 6 months, earnings haven't mattered. But if normalization is getting the coronavirus under control, that means that emergency measures will start to go away on the financial side. And you'll see a period like 2015 and 16 again, where the market chops sideways, but with a lot of winners and a lot of big losers. And I really think that's what we're in store for. Maybe the stock market chops along and doesn't have a gigantic correction, other than a couple of margin sell-offs, right? No depression, other than what we're already in, because 42 million Americans are in poverty right now, up from 34 million, which actually had been the lowest in history, if the measures were correct. I've had my problems with the measures coming out of this administration, from energy to counting how many people had coronavirus. So if you're on margin of safety, let me point something out that you may not have seen yet, because I just sent it out over the weekend. I put out a welcome message with facts to make it a little bit more convenient. What's in the resource center? Use the symbol and keyword search. Follow the price alerts. This is the rough publication schedule. I actually have this article done right now, so I'll go up after the call. Stocks of the week will go up tonight, and I'll add some things I didn't talk about today so far. So this should make it very easy to follow along here. If you ever need to know where something is, just go ahead and click on it. But one thing you should get used to using is the search engine. So all you gotta do is go to latest, say IPOC. Have we talked about that? No, there's nothing up here on that. But I guess the takeaway on any of these companies is relative performance against other companies in their industry. Are they capital intensive? If they're capital intensive, to what extent are they impacted by the credit cycle? And we've had a 40-year secular bull market in credit. Pretty much by definition, because we're near zero on interest rates, it can't go on 40 more years. Go sideways, but during that time, debts come due. If they can't be refinanced for less, what happens? Interest expenses go up. At what point do the bond vigilantes, right, the people who insist on a return on their money, say we're just not going to buy any more debt from the US government? Some nobody named Jamie Dimon, who apparently is the CEO of the biggest bank in America, said he doesn't want to buy US treasuries anymore. That's the same thing that China's been saying. So right now you have negative real interest rates. Negative real interest rates means that the interest rate minus the inflation rate is negative. And you might take that for a year or two if you're uncertain about things or you just need to park cash. But why would anybody buy a long-term US government bond with a negative real interest rate? You might as well bury your money in the ground or buy gold. And for the moment, until Janet Yellen submarines at Bitcoin, I say there's a 90% chance that Janet Yellen submarines Bitcoin. It's only that 10% chance that makes me put 1% of my money in there. Just in case the corporations really do rule the world and they overrule the US Treasury and take over the monetary system. In which case, you should go watch a whole bunch of sci-fi movies about how the world turns out. So I do apologize. I had a typo somewhere. So I changed the time of this call 3 weeks ago. And I had a typo that had in one spot it said one spot it said the other time. But we're doing this at 4 o'clock now so that I can have dinner at a normal time. Plug and play growth stocks. There's nothing cheap. Plug and play dividend stocks. AT&T, Lumen Technologies, Northrop, Erstat Biddle, Kinder Morgan, probably stop at those 5. Northrop Grumman, Raytheon, and Lockheed are all kind of heading down together. If you like the group, I would hold off on buying any of those stocks, and we can use an ETF to buy the group instead, which gives us exposure to the small caps. So I think we've talked about that before. Here is the company that I think is ultimately the winner in coronavirus vaccines. I do think they have the best technology from the standpoint of safety and efficacy. So here's one that I'm interested in. So let's take a look at this. Right, it's real close. Now this area here, if there's a stock market correction, it's going to come through here. So you want to buy it in here. So about 68-ish on a stock market correction, because again, the buying pressure probably moves up a little bit, starts to fill this gap in. I am actually working on this, and this is a website that I'm using. Merck isn't really behind on their research and development at all. It's just that what they're putting together takes longer. mRNA is fast to market, but probably doesn't have the safety features that most people are going to want. It's probably not going to be as low side effect as the more traditional vaccines, the platform that Merck is working off of. If you go to New York Times or the Milken Institute, they have the lists of the vaccines and how they're being developed and the technologies that they're using. It's pretty easy to figure out who the leaders are. Merck sells more vaccine than anybody in the world. They're good at it, and they don't kill people. So SPAC Track is what I was trying to get you to. SPACtrack.com. Oh. There you go, SPAC Track. Go to this website. Pretty interesting. You have a full list of all the SPACs out there. They give you a lot of the news. It's a pretty good website. I will say that most of these SPACs, because they were, and here's why they moved up so fast. Same reason as the market moved up fast is huge liquidity, but in the really thinly traded stocks. I will say that half of these companies never turn a profit, and the majority of them they round trip back to their IPO price or below. So you gotta be real careful with these and make sure that they have the right partners, and make sure you always ask yourself a question, is this so a bigger guy can exit with his cash? Right? A lot of IPOs and a lot of these SPACs are people just trying to exit private equity or venture capital investment and to get out of it and unload it on the public. That's been going on my whole career and before me. So certain SPACs I think are pretty interesting. The one that I told you that I really liked, MP, apparently the market likes this one too. So I liked it way back here, and it keeps going up. I don't even know what the market cap is anymore. But like I said, I think this is going to be an S&P 500 stock at some point. Where we buy it, I don't know. I mean, I'd hate to have to buy it way up there. These gaps up, when there's 2 gaps up, you kind of go, actually three gaps up. It makes me think that there's a really big buyer, right? Bought it again maybe. I don't know. Is somebody accumulating a huge stake in this company? That would suck for me. It was an idea that made sense to me from day one. I do know that there's another guy out there with a bigger investment letter than me that's on this one too. See where that candle got to and where that candle got to. 25. Yeah. What's hard about this is that there's not There's no Fibonacci. There's nothing that you can do for this. You just got to measure liquidity, which is what this side is. So I would think that they give this back unless there really is a giant buyer just buying it all. So you have to buy it at 30. I don't know. I don't even think these guys have anything on it yet. It's their market cap, $4 billion. It might still be a double from here, in which case you'd buy it at that higher level. You bought 100 shares of MP? Yeah. What did you buy it at, Vince? 21? Yeah. Good for you. Yeah. I truly don't know where to put these prices. No idea. I said it's going to be a $10 billion company. It's up to 4. It's tripled since I brought it up. I've talked about some of these stocks, and, I too am guilty of not making enough commitment. And I too have been waiting for more of a correction. We haven't got it. But I will tell you that this list of SPACs that they have here is pretty, right here. Oh, no, I did that already, didn't I? Yeah, so here's the free version, right? And then looking in here, you want to see who's in here if you can. Go all the way down to the I's. You get your 3 companies by social capital. These are the Medicare supplement guys. So you'd have to ask yourself the question, who's buying Medicare supplement company? This is the one that I didn't think much of. It's probably still up though. But yeah, take a look at SPAC Track. It's pretty neat. Yeah, that's why I tell folks to scale in and scale out. So somebody said too much fog yak, too much fear of getting your ass kicked. And you should always have that. And that starts with asking the right questions. But sometimes, even if you do a 0.5% starter position, when you become convinced about something, it's worth taking that 0.5% and starting the position. And then if it goes down 10 or 20%, you review and say, okay, it's down 10 or 20%. Am I right about this, or is the market telling me something? Sometimes it's just volatility. Sometimes the market is telling you something. If you are down 20% on a 0.5% position, you go, the market's going to hate this forever. You lose, but it's small. Or you say, no, this is just volatility. I'm right about this. I'm going to add another 0.5% or 1%. So, when I mention a new company, you pretty much should look into it. Does it fit your asset allocation? And that's an important question. Would it be in that 20 to 30 punch card if that's all the stocks you could ever buy? If I could only buy 30 stocks, would this one make the cut for quality? And the more and more I look at these companies, which is why I'm going to cut the VSL down, is because is that there's just not a lot of great companies out there as far as I'm concerned. There are hugely capital intensive companies out there, right? A huge amount of capital intensive companies out there, which are never ever going to justify their stock prices given their debt loads. It's way over the 30% that are officially zombie companies as far as I'm concerned. It's way over half from what I can tell. Because you have to ask yourself the question, how much cash can they throw off to shareholders? Take a look at the banking industry. With these low interest rates, they're not really making a ton of money, but the Fed keeps giving them money. So the Fed approved the banks to do buybacks. Do you think that drives bank stocks up much? I think it's kind of a stealth bailout because they know these banks are in public service now. They're not big profit generating corporations. I love the banks if interest rates are 4 or 5%, because then you start another era of, well, we can just keep refinancing. But the era of we can keep refinancing is ending sometime this decade. And I don't know what to tell you. If we're going to get a mini correction coming up, but you need to be very aware of the risks. And the idea that dividends are payable forever from companies that can't even pay their debt, you go right through the REIT list and you'll see half of the REITs are in trouble. That those prices that a lot of the REITs got to in March, that's probably where they should have been. So let's stick with the companies that are changing the world or responding to the changes in the world. Your technology companies, some of the healthcare companies, some of the consumer companies, companies that can create more revenue and more profit without having to put a ton of cash on the line themselves. Companies that are asset light, low capital intensity, right? Why did I become bullish on AT&T? Well, they have a valuable asset that can't be replaced. That's the capital intensive side. So the capital intensity is offset by the fact that there's not a lot of competition there, right? It's 4 or 5 players. And those hard lines can't be replaced. Very hard to even compete with them with new lines. Who's going to spend that kind of money? Somebody who wants a fiber optic network is more likely to go out and buy Lumen Technologies than they are to go and put a whole bunch of wires in the ground. But wait, there's more. The real kicker for AT&T is that, and I played with it this weekend again, is that HBO Max, I challenge anybody who has AT&T cell phone, you probably get HBO Max for free as part of your cell phone package with AT&T. It's hard to figure out how to log in the first time. But if you have an AT&T cell phone package, you probably get HBO Max. And if you haven't been using that or didn't know that, just follow the steps. It really is only 4 steps. So now I get HBO Max, and I compared it to Netflix over the weekend. And I'll tell you what, I think HBO Max is going to end up being better than Netflix. I think Netflix might end up in 3rd place behind Disney and HBO Max. Why would I say that? Because Netflix doesn't have the gigantic catalog, right? Netflix only has what they get from other production companies and then what they produce themselves. Whereas Warner and Disney have these massive catalogs going back decades. So that means that Sony, which is on our international list, is an interesting company. Now, the thing is I talked about this company years ago. I think you got to ask yourself a question about Sony. And what's that question? Are they going to sell their studios? So it moved in the sideways area for a long time, and then it spiked up, which is what it did way back during the tech boom. So I guess maybe if you're a momentum player, you can play that. But if you get rid of the spike and this spike, just look, right? 2 spikes. It's not like Apple where it just keeps going up, right? Or Microsoft. So compare Microsoft, right? Is that funny looking? So anyway, but Sony's interesting if they sell off their studios. I don't know if they ever would though. So that's what I'm saying is, how does Netflix compete with HBO Max and Disney who have these giant catalogs? When Apple and Google, or maybe Facebook, and they're not, or Microsoft, I guess. I mean, there are not many companies that go out and buy Sony studios. Netflix doesn't have the money, and if they did get the money, it would come at either huge dilution or huge debt. I'll tell you what, I like Disney and HBO Max better than I like Netflix right now. And there's 4 or 5 shows I watch on Netflix. So I'm going to end up having all 3, plus CBS, because of Star Trek. So weirdly, pulling the plug is not going to end up being cheaper than an all-inclusive cable package, right? That's what we all thought years ago. Well, I want to buy my cable a la carte. Okay, everybody's unplugging, and now you're buying it a la carte. $14 for HBO Max if you don't have AT&T, $12 for Netflix, $10 for Disney, and that'll go up because of all the Star Wars stuff coming out. And if you want CBS because of Star Trek, there's another $10 a month. You start adding it all up, I'm going to have to get faster internet now, so that's $100 a month, right? You go, oh, Christ almighty, I'm paying $200 a month instead of the $100 that I was. Yeah, and I don't know that Sony can be sold, honestly. Somebody mentions that all the companies are kind of interweaved over there, and the government owns a big hunk. In France, they don't let a lot of the companies get bought because the French government has a stake. The one thing that would make me vote Republican at some point would be if we started socializing the capital markets even more than they are. Take a look at the innovation of Europe compared to ours. Take a look at the innovation in Japan over the last 20 or 30 years compared to ours. There's no doubt the United States has the most innovation. We have to let companies be companies, even if there's certain directions that we want them to head in. Once you start controlling their purse strings too much, I don't know that you get the entrepreneurship that you need. I mean, I already see the entrepreneurs at the smaller level dying off. And my hope, and I want it to be an expectation, but my hope is the millennials now pick up the small business mantle that the boomers are retiring out of. Some by force because of coronavirus. Others are just getting older, right? Somebody asked about microcap stocks, and I think that microcap stocks do well because you're mini millionaires, right? Your guy's worth 2 and 10 and 20 and 30 and 50 and $100 million. get a hold of these companies and they use them to replicate their successful business in Milwaukee or Pittsburgh or Denver and to take it to other places. Sort of SPACs at the microcap level. I think microcaps are a place to look. They'll be higher risk probably because to get growth, that means they have to expand. To expand, that means they need capital, and it means that they have execution risk. And what if that thing that was popular in Milwaukee just isn't going to make it in LA? So those are places where I think you're looking for home runs. I don't think you put more than a single-digit percentage in microcaps. But if you pick out a basket of them, 6 or 7 or 8, however many you keep track of, and one of them is a home run that goes up 20-fold for you, now all of a sudden that's an awful lot of money dropped to the bottom line some year. But anyway, 4 o'clock on Mondays now so that I can get to a normal dinner time. Yeah, I've already been working about 8 hours at 4 o'clock, maybe 9. And think about the credit cycle. Think about capital intensity. Because I know people are getting tired of me warning about a correction. But every day that goes by, we're closer to it. So I want you to think through what it is you want to own after that next correction hits. And don't be shocked if it's 20 or 30% in a month again. Just understand that that makes sense. And that you have to monitor the margin selling every week. And the week that the margin selling is done, you have to start buying. Probably a lot, probably fast, right? Putting out the bucket instead of the thimble like we've had now. One last word on gold. Somebody put out a letter, it might have been JP Morgan, it might have been Morgan Stanley, I don't remember, that said that gold is going to be hurt by Bitcoin. I think that's 10% likely because I think it's 90% likely that the government start going after Bitcoin soon because they don't want corporations and institutions getting into Bitcoin because it would cause them to lose control of the financial system. So I would anticipate that Janet Yellen has some negative things to say about Bitcoin soon because I don't think she's on the take. And I think she understands that counter-cyclical policy works less and less if wealth inequality and hoarding gets worse, that all this money that's been hoarded somehow gets sucked out of the financial system and becomes dark money. So I would expect a pretty interesting conversation from Janet Yellen with regard to Bitcoin at some point. And it will include, if we catch you cheating with Bitcoin, the penalty isn't 10 or 20%. The penalty is 100% in jail time. And if we think that it's even a bigger problem, we're just going to tell every financial institution in the world that if you want to participate in the SWIFT system, you can't deal in Bitcoin. And if you're a corporation keeping money in Bitcoin, you can't sell your products here. That's how you control it. Big, big fat sticks with 80% of the money in Bitcoin and 2% of the accounts. And one of the guys is Saylor. With them out there trying to tell institutions to buy this Bitcoin from them at higher prices than they paid, 3, 4, 500% gains. You got to wonder, is that just an exit strategy? Or is it a strategy to take over the world? Either way, I can't imagine the governments are going to stand for it. And if they do, again, watch some of the old sci-fi, watch Mad Max. All right, have a good night. I will edit this tonight and get it out there, and I'll put a bunch of charts up, companies from the plug and play. Make sure to stick with the plug and play, for the most part. Don't spread your net too wide. Focus on a few dozen companies. All right, take care. Have a good night.